Hello, today we will talk about forecasting exchange rates. So we'll talk about why firms should be forecasting exchange rates, what are some of the benefits, describe the common techniques used for forecasting. We'll also talk about how you can evaluate your forecasting performance. So you always want to go back and see how good a job you are doing in financial forecasting or in forecasting exchange rates. And we'll talk about the common ways companies try to do that. So why should we try to forecast exchange rates? So the first one is hedging decision. So as an example, you are a company like Apple, you are exporting your products all over the world. So one of your concerns is what is going to happen to US exchange rates? Is the US dollar going to increase in value or is it going to decrease in value? So if Apple finds that the dollar is going to decline against other foreign currencies, perhaps Apple does not need to hedge. On the other hand, if the currency is expected to appreciate, Apple should try to do something to hedge their exchange rate exposure. What about short-term investment decisions? So here what we are talking about is that a company such as Starbucks or Google, they have operations all over the world. So in this case, they get paid in euros, they get paid in pesos and so on. One of the questions they have to ask is that, do we want to bring the money back immediately or should we wait? So in both these cases, if the US dollar is expected to weaken, it might help these companies to keep their money abroad for some time. The third one is capital budgeting decisions. So one of the cases typically we have in class is Merck making an investment in Mexico. So in this case, whenever we have a capital budgeting investment, a big investment, you have to be in the foreign country for 5 years or 10 years. So your forecasts are based upon both the cash flows and the exchange rates. So in this case, you need to have some good forecast regarding the exchange rate. So we are talking about 5 years or 10 years down the road. The fourth one is earnings assessment. So every quarter, firms have to have an assessment regarding their earnings. They need to have some forecast, and in this case, if you have a lot of operations outside the US, it becomes very important to forecast exchange rates. And the last one is the long-term financing decisions. So in the case of the long-term financing decisions, what we are talking about is that where do these firms raise money? Do they raise their money in the US? Do they raise it in Europe? Or in other countries? So in all these cases, one of the factors that becomes important is the interest rate is important, the exchange rate also is important. So for example, you could be able to borrow in euros for 2% or 3%. That is a good deal, but if the euro is expected to appreciate against the US dollar, some of these projected savings will go away. So these are, at least 5 reasons why firms are interested in forecasting the exchange rates. So this summarizes the corporate motives. The first is deciding whether to hedge foreign currency cash flows. That is one thing. The second is deciding whether to invest in foreign projects. The third one is deciding whether foreign subsidiaries should remit earnings or keep it in the foreign country. And the last one is where to raise financing. Should we issue bonds in the US, outside the country, and so on. So if you look at the financing decision, that influences the cost of capital. And our objective should be to decrease the cost of capital. Now, when you talk about hedging foreign currency cash flows, whether to invest in foreign projects or whether to foreign subsidiaries should remit earnings, in all these cases, all these will affect the cash flows that you're going to receive. And here, a higher cash flows will increase the value of the firm. So these are, like I said before, some of the reasons why a firm should be interested in forecasting the foreign currency cash flows. Okay. Now, what are the different ways you can forecast? The first one is technical forecasting. The second is fundamental forecasting. And the third one is market-based forecasting. So what is technical forecasting? In the case of the technical forecasting, it involves the use of historical exchange rate data to predict future values. So basically what we are saying is that if you look at the past trends in the exchange rate, so that could be the movements of the euro versus the dollar during the last month, during the last 6 months, or during the last year, and so on. Basically what we are saying is that we can use that to make some predictions regarding the future exchange rate. Now, we do the same thing in the case of stock prices. So technical forecasting is a big area in the case of the stock market analysis. Now, what are some of the limitations? The first is that it might be effective only for the near future, so very short term. The second is it rarely provides point estimates or range of possible future values. So what we are trying to do is that we are trying to look at trends. We are looking at charts and trying to make predictions. And the third one is that technical forecasting model that worked well in one period may not work well in another. So here what we are saying is that if more and more people, for example, if your competition is also going to use the technical forecasting, any advantage that you have might go away. So that is one of the issues whenever we talk about strategies either in forecasting exchange rates or in forecasting the stock prices. In both those cases, as more and more people understand what you're doing and try to imitate you, any advantage that you have will go away. Now, what is fundamental forecasting? So fundamental forecasting is based upon fundamental relationship between economics variables and exchange rates. So in chapter 2, we talked about several variables that can affect the exchange rate. So some of these are inflation, interest rates, the GDP, expectations, and government controls. So all these we can use to make some predictions regarding the exchange rates. And what is the fundamental analysis? Use of sensitivity analysis to account for uncertainty by considering more than one possible outcome. So the nice thing about fundamental forecasting is that once we create a model, so for example, we have a regression saying that the exchange rate depends upon the inflation, it depends upon GDP, it depends upon interest rates and so on. We can give different values for these variables and we can see what happens to the exchange rate. The third one is use of PPP for fundamental analysis by forecasting inflation differentials. So in chapter 8, we talked about the purchasing power parity, and there what we said was a currency, the changes will depend upon the inflation differentials. And what we said was countries that have high inflation, we can expect their currencies to depreciate. Now, what are some of the limitations of fundamental forecasting? Some of them are unknown timing of the impact of some factors. So you're not sure whether there could be changes. So for example, your predictions regarding inflation could be wrong or could be off the mark. Forecasts of some factors may be difficult to obtain. So we talked about government controls and government actions. It's very difficult to make some predictions. Some factors are not easily quantified. So for example, it is very difficult to quantify expectations. And the last one is that because things change over time, the model we've developed for one period may not work in the other period. And again, the reason being that more people catch on to your model and they try to do the same thing, any such advantages you have might go away. Okay. So what is market-based forecasting? Use of the spot rate to forecast the future spot rate. So what we are saying here is that the current spot rate is a good predictor of the future spot rate. The second is use of the forward rate to forecast the future spot rate. So there, whenever we go to finance or economics, people usually say that the current forward rate is the best predictor of the future spot rate. And what we did say before was we talked about the expected change in the spot rate. And that is given by F minus S over S, and that is given by the forward premium or the forward discount. Now in reality, what do companies do? So clearly, people who do this type of work, they have they have scientific, but at the same time they also tend to have their biases. So what depends is, depending upon your biases or depending upon your inclination, you will tend to use a combination of the forecasting techniques. So you might use market-based forecasting, and you can use perhaps fundamental forecasting, or you might put more weight on technical forecasting. So here, the mixed forecast is a weighted average of the various forecasts developed. So we talked about 3 ways you can forecast. We talked about technical forecasting, we talked about fundamental forecasting, and we talked about market-based forecasting. So the model you use might use different weights depending upon your preferences. So here is an example of that. What we find is that the technical forecast, we are saying that you're looking at the recent movement in the peso, And what do we find here? The peso's value declined below a specific threshold in the last few weeks. So what we are saying here is that perhaps there is a minimum value and a maximum value for the exchange rate. And what we say here is that if the peso's value goes below the minimum, perhaps it might go down even more. Okay, so basically here it has hit the lower barrier and it has gotten below that. So there's a high chance that it can continue to go down. The second one is the fundamental forecast, and we are talking about economic variables such as economic growth, inflation, and interest rates. And what we are saying here is that Mexico's interest rates are high and inflation should remain low. So we are talking about the real rate of interest and being high, and if that is true, the peso's value will rise as US investors capitalize on the high interest rates by investing in Mexican securities. So in this case, because the real rate is higher in Mexico, people might move their money and invest in Mexico. And the third one is the market-based forecast. We are talking about the spot rate and the forward rate. We are talking about the forward rate being a good predictor of the future spot rate. And the peso's forward rate exhibits a significant discount which is attributed to Mexico's relatively high interest rates. So here, based upon the forward rate which provides a forecast of the future rate, the peso's value will decline. So what we see here is that two of the three methods say that the peso is supposed to decline, and one of them, the fundamental forecast, says that it is expected to increase. Okay. So based upon this, what we are saying is that perhaps there's a high chance that the peso will decline. Now, how do we measure the forecast error? The forecast error is given by the forecasted value minus the realized value divided by the realized value. Okay, so we are talking about the forecast error as a percentage of the realized value. And what we can do is that we can look at our predictions model over different time horizons, over different time periods, and among different currencies, and we can see whether there is any forecast bias. Okay. So the first one is that forecast error and volatility. So we have several currencies. We have the Chinese yuan, the Canadian dollar, the pound, the peso, and so on. And what we have is essentially we are talking about the relationship between the forecast error and the standard deviation. And what is the analysis we find here? Basically what we find here is that the higher the forecast volatility, the higher would be the forecast error. So essentially what we are saying here is that for currencies that have high standard deviation or that have high volatility, it is more difficult to predict their values. So it makes sense. Now the least volatile currency is the Chinese yuan. Now one of the reasons why it is least volatile is because till very recently the government has been having strict controls over the currency. Now they are trying to relax those their control, and perhaps it can become more volatile. Now if you look at the highest risk currency or the highest standard deviation, that is the peso, and we will find that the Canadian dollar is not too volatile. It moves very closely to the US dollar, and we find that it's easier to predict. So if we want to do some tests, so what we are saying here is that the current forward rate is the best predictor of the future spot rate. Now how can we see whether it is good or not? We can basically run a regression where we have the current spot rate and we are looking at how it is related to the forward rate in the previous period. So for example, we are in March. We want to see whether how good the forward rate for April can explain the actual spot rate in April. So what we do here is that after we move to April, we can collect the spot rate in April and we can see how it is related to the current the forward rate in March, the March forward rate for April. So what we are doing is that we are trying to look forward. We are in March and we are saying how it is related to the April spot rate. So the regression we run is ST, that is the spot rate in April, is equal to A0 plus A1 times FT minus 1. So FT minus 1 is the forward rate in March plus mu t, and mu t is an error term. So what we are saying here is that overall, when we run the regression, the error terms will cancel out. It becomes 0. Okay? So if our regression is good, what it tells you here is that we will find that the coefficient for A1 is significant. So the number for A1 would be large, and ideally it should be 1. And not only should it be large in terms of the size, but it also has to be large in terms of the statistical significance. So that is typically what people try to do. And if you run a regression like this, basically what we see here is that we have the realized value and we have the predicted value. So the regression line is the blue straight line, and what we find here is that 1, 3, 2, 7, 8 and 4, these are points below the line. So what it tells you is that for those points, the regression line is overstating. Okay, the values given by the regression line are higher than what it actually is. And if you look at point 6, what we see is that the regression line is understating points like point 6. So all said and done, what we find is that a lot of the points are below the line. So it looks like our regression has an upward bias. It is overstating the future spot values. So the forward rate looks like it's a little bit lower than the future spot rate. Now we have the regression for different currencies. We also have the regression for different time periods. Okay, so this is for the entire period is April 2005 to July 2008. It looks like we have a very good model. The points are all over on either side. That seems like a good fit. Now for the first time period, so April 2005 to January 2006, it looks like a few of the points are below. So what we are saying here is that the regression is overstating. And for the January 2006 to October 2007, we find that a lot of the points are above the line, which looks like the regression is understating. And October 2007 to July 2008, it looks like it's a pretty good regression. There's only one point which is slightly below the line. So what we find is that overall it seems to work well, but in different time periods, the performance of the regression is varying. In some time periods it's good, and some time periods it's not a very good predictor of the future spot rate. So now we want to talk about forecasting under market efficiency. So when you talk about market efficiency, you can perhaps go back to what you studied in investments or in corporate finance. So in both these cases we talked about the efficiency of the stock market. Here we are talking about the efficiency of the currency market. Now what is weak form efficiency? Basically weak form efficiency is that historical and current exchange rate information is already reflected in today's exchange rate. So what we are saying here is that the past exchange rates, they will be incorporated in current exchange rates. So what we are saying here is that we talked about technical forecasting. So if the markets are weak form efficient, what we say is that the technical forecasting is not going to help you, because all that information is already reflected in the current exchange rates. Okay. The second one is semi-strong form efficiency. All relevant public information is already reflected in today's exchange rate. So for example, you just heard in the news about something happening to Greece, some bad news about Greece, so that can affect the exchange rate of the euro. And what we are saying here is that if you run and try to trade the currency based upon the news you just heard, chances are it's not going to help you. And the reason why it's not going to help you is because there are hundreds of foreign currency traders, there are hundreds of banks, all of them, their main job would be to follow the exchange rates, and chances are they are going to beat you to this news. Okay. The last one is strong form efficiency. All relevant public and private information is already reflected in today's exchange rate. So essentially here, what we are saying is that in the case of the exchange rate, even somebody who works for the central bank, they cannot trade and make money based upon this type of information. So all said and done, the strong form efficiency does not work. That is for sure. And what we know, at least about the stock market, is that insiders do trade and make money, and chances are even for the currency markets, if you look at perhaps the trades made by informed people, there's a very high chance that their trades are going to be very profitable. So let's look at some examples. Assume that foreign exchange markets were found to be weak form efficient. What does this suggest about utilizing technical analysis to speculate in euros? So if you look at this, what we would find is that technical analysis is not going to work if markets are weak form efficiency. And the reason being that we are saying that if the markets are weak form efficient, chances are the current exchange rate reflects all the past information. Okay? Now, if MNCs believe that foreign exchange markets are strong form efficient, why would they develop their own forecast of future exchange rates? That is, why don't they simply use today's quoted rates as indicators about future rates? So here, when you talk about strong form efficiency, what we said was all relevant public and private information is reflected in today's exchange rate. So given that, if that is true, why should companies try to even bother to forecast the exchange rates? And the reason why they want to do that is because today's exchange rate or today's forward rate gives you only one number. Because you are trading perhaps in millions of dollars or even billions of dollars, you want to have more confidence. So you want to look at all the possibilities and then you want to make some decisions. So that is the reason why companies might still want to use some forecasting methods, because they need to figure out the sensitivity of the analysis. They want to find out on average what's going to happen, what is the most they can make, and perhaps what is more important is what is the most they can lose. So to do all that, they need to have more sophisticated forecasting. Okay. So this one, testing for a forecast bias, you must determine whether there is a forecast bias in the forward rate. You apply regression analysis to test the relationship between the actual spot rate and the forward rate. So basically here, you are running a regression which says that the spot rate is given by A0 plus A1 times F. And here, when you ran the regression, the variables you find are A0 equals 0.006, A1 equals 0.8, standard errors are 0.011 and 0.05. So how do we do that? So it looks like A0 is significant in terms of economic significance. A1 also is large. But all said and done, ideally we should expect A1 to be 1, and that is not true. And we can also test for the statistical significance. So how do we test for the statistical significance? That would be the coefficient divided by the standard error. So the coefficient is 0.006 and the standard error is 0.011. So the t-statistic is 0.55. So typically a t-statistics below 1.96. So 1.96 is the 5% level of significance, or 1.68 I think is the 10% level. So anything below the 10% level, you don't consider that at all typically. So here the t-statistics is very small, and given that, you can pretty much ignore that. Now the t-statistics for A1, what we are trying to do here is that is A1 significantly different from 1? The number we get is 0.4, and clearly 4 is a very large number, which tells you that A1 is clearly significantly different from 1. But is A1 significant? For that we can take 0.8 and divide it by 0.8 divided by 0.05. I think the number you get here is 16, I believe, and that is a pretty large number. Okay, 0.8. So it is 16, which basically tells you that clearly A1 is different from 0. Okay. And what we are saying here is that how good is the model do we have? The realized spot rate is significantly below the forecasted rate. Thus the forecast contains an upward bias because it is overestimating the future spot rate. Now how can we forecast the exchange rates? Exchange rate volatility. So we want to make some predictions regarding how risky or how volatile the future exchange rates are going to be. And we can also look at historical pattern of volatilities, and we can look at the implied standard deviation. So what does it mean? in the case of the what we are saying is that the current volatility is a predictor of the future volatility. That's one way we can forecast the future exchange rate volatilities. The second is use of historical pattern of volatility. So we can go back, collect the exchange rates, and we can look at the standard deviation, the average values, and so on. That is the second way to predict the volatility. And the third one is the implied standard deviation. So what is the implied standard deviation? So here what we are saying is that if you look at option prices, one of the most important variables that enter into the Black-Scholes model is the standard deviation of the exchange rate. So what we are saying here is that we can look at the call prices and put prices and try to back out a standard deviation, and that would be the implied standard deviation. So I just want to conclude, some of the things we talked about as far as this chapter is concerned. So what are some of the things we did? Basically, we talked about the reasons why companies use exchange rates forecasting, and basically what we said was that they use forecasting for hedging decisions, they use forecasting for investment decisions, they use forecasting for capital budgeting decisions, earnings assessment, and long-term financing decisions. So if you look at the long-term financing decision, the primary reason why they want to look at that is because they want to see what are the methods that can decrease their cost of capital. And if you look at the hedging decision, their short-term investment decision, the capital budgeting decision, and the earnings assessment, all of these are used to perhaps increase the future cash flows. And all of them again will increase the firm value. Now we also talked about how firms can benefit from forecasting exchange rates. So they can use their forecast in all these things we just talked about. We talked about the common techniques used for forecasting, and that would be the technical forecasting, the market-based forecasting, and the fundamental forecasting. And we also talked about how forecasting performance can be evaluated. So basically there, what we did was we went back and we collected the information, and we want to see how good a forecast we are having. So this is a relatively simple chapter. I think the main thing you want to focus on would be look at the regressions and make sure that you are comfortable with evaluating the regressions.